Okay, folks, let's go ahead and get started. We've got three really nice papers today. Just to remind everybody, we're going to do 15 minutes for the talk, 10 minutes for the discussion, and then we'll try to fit in a few questions. If you're going to ask questions and you're in the room, you're going to have to come up here and ask them at the podium. So kind of get ready if you have a question to come up and give your question. Okay, so let's get started with the first paper. You have 15 minutes, and I'll give you a warning when you get 5 minutes away.
Sure. Thank you so much. Thank you so much for allowing us to present our paper today. So I'm going to talk to you about public health shocks and product pricing behavior. This is a joint work with Gustavo Cortes from the University of Florida. So to give you an idea of what the paper is about, a bit of the motivation. So most of the literature so far in the insurance industry focuses on financial crises. So you have a lot of interesting papers. For instance, Gron and Winter says, well, pricing behavior matters because different institutions have different capacity constraints. So the more capacity you have to take on life insurance or non-life insurance contracts, that is going to differentiate in terms of the pricing behavior you're going to have. Now, more recently, Cohen and Yogo says, well, sure, that's true, but the variation in pricing mainly comes from financial friction, so the capital structure, and also product market friction, so somewhat of competition. And then more recently, G says, well, sure, but we show that prices decrease for those products to create an immediate impact on your balance sheet. So you lower prices of life insurance products to get in more cash. In a more general literature, Kim also shows that pricing decreases for those firms closely related to the Lehman Brothers bankruptcy. It was somewhat of a fire sale behavior. So overall, this literature mostly shows that prices will go down following financial shocks. Now, our question in this paper is, what happens during a public health shock? Now, the most general problem in this field is data availability. So COVID is still ongoing, so you cannot really infer much out of that. So therefore, we actually turn to the 1918-1919 influenza pandemic in the US. So our idea in this paper is we're going to exploit a variation in exposure towards the pandemic for specific life insurance companies. We're going to differentiate between low exposure companies and companies that had a high exposure to the pandemic. And we're going to focus on life insurance. Why? Because this is a rather homogeneous product. So it's similar across states, and also regulation was somewhat similar across states. There were some differences, but across the board, it's relatively similar. We also focus on life insurance because this is a somewhat peculiar industry in the sense that the customer is also the debt holder. If you buy a life insurance product, you become the debt holder because if you pass away, your family will get that receipt. So in that sense, you're somewhat of a debt holder as well. And we argue that's the most affected sector for several reasons. Now, we believe that going back into time, that history can actually help us to better understand pricing behavior. So a small word about influenza pandemic. So the first case was in March 1918 in Kansas, came in due to a war veteran. First wave was somewhat mild. It was the second wave that was the most deadly. Started in November around Boston, which was very, very crucial. Now, there was also some minor third and fourth waves, for instance, in New York, but these were of less importance for the rest of the country. Now, what makes this historical episode so appealing? It was very severe. So case fatality ratio 2.5%, which is similar to what COVID was, especially in March 2020. Now, for our study, this is a very distinct period because it affected younger adults much more. So if that is indeed the case, life insurance companies who price in these specific risks are going to potentially adjust their pricing behavior for new customers due to this huge unexpected shock. And also, a lot of literature shows that this public health shock didn't coincide with an economic downturn. Now, this was the case for COVID-19, so this provides a better and neater way to actually learn something about public health shocks. Now, to show you the relationship with life insurance is the growth rate in new policies. So it varies between 0 and 20% before the pandemic, but there was a distinct increase after the pandemic. So once the pandemic occurred, actually the importance of life insurance, the awareness increased significantly. So this is both for low exposure and high exposure life insurance companies. So the industry itself, where do we get our data from? Well, our main source is going to be the Spectator, which is still around today. So we have a lot of balance sheet information, such as total admitted assets. So we know which type of asset classes these life insurers actually invested in. We also know the liability structure. We know a lot about their total income, disbursements to get an idea about operating profitability. And we know a lot of firm specifics, like in which states they were active in, how much life insurance in force they had, whether or not they retired, which is a synonym for bankruptcy, the age. Well, these are all things we're very much interested in and we have access to. So within our main study, we focus on all life insurance companies that had at least 1 year of data pre-1918, so pre the outbreak. So we're going to exclude all bankruptcies that happened before. And in a first stage, we're also going to exclude all new incorporations. Now, in a later stage, we're going to include those new incorporations as well to learn about those differences. And for a secondary source, we use BEST, which is also still around nowadays as well. So our main variable of interest is going to be price. And price we're going to define as the value of new contracts divided by the number of new contracts. This will be measured in 1917 US dollars to get inflation out of it. So the definition is basically the average price of newly issued life insurance contract. But it can also be interpreted as a single premium contract. So to give you some sense, the summary statistics, the average price is about $1,840 US. Also, these life insurance companies were relatively big. The average life insurance company was bigger than the average bank at the time. So this is a very important sector. So what are we going to do? Well, we're going to run a difference in difference model where we use price as our dependent variable and then high exposure times post. So you're a high exposure company if the 1918 mortality per insurer is above the industry average. Post is going to be an indicator variable from 1980 onwards, and then we have a large number of control variables. We're also going to control for the distance to a military base to control for these World War I events. Then we have some additional econometric specifications such as a year fixed effects, life insurance fixed effects. We're going to cluster our standard errors at the insurer level. And as I mentioned on the slide, we also have plenty of robustness checks to be in line with the recent difference in difference literature to really control for all of these things and to make sure that our results are robust. So what do we show? First of all, the post variable suggests that prices on average for the average life insurance company are going down. So this is in line with the literature that focus on financial shocks. So prices on average go down. Now, more interestingly, the price for high exposure companies actually goes up. Okay, so that's something we see, and that is significant at least a 5% level. We also control for a lot of other things, as I suggested, and all of these signs are in line with the previous literature as well, such as asset growth, which is positive, size, which is also positive, and leverage, which is negative. So this at least seems to suggest that everything is in line with the literature, only that high exposure companies increase their prices. So then we actually ask the question, why is that? Okay, so this effect, as I suggest, is statistically significant. The economic magnitude is also relatively large, so around $120 US, which is about $2,350 US nowadays. So this is huge. Now, one question we have is, sure, this effect is there post-pandemic, but is there a difference across years? Okay, now that is something we show there is. So the effect mainly occurs in 1918 and in 1919. So at the zeitgeist of the outbreak of the pandemic, that is what most of the action is actually occurring. Now, we have a lot of robustness checks, so we changed our treatment period, our control group somewhat. Also, we did a placebo test to make sure that we are capturing the right thing. So we assumed that the influenza pandemic happened in 15 or 16. Also, we focused on these new incorporations where we see those differences in price as well. Now, in a bigger term, there are a lot of potential explanations. So maybe these are also these financial constraints, these financial frictions that play a role. Or, as Cohen and Jaeger suggest, maybe competition is at play. There is another literature that focuses on regulatory frictions. So these are things we're actually going to control for. Lastly, there are also policyholders' characteristics. Maybe there's a difference in the actual new clients of those companies, but then we actually turn to narrative evidence that this doesn't seem to be the case. So the policyholder, on average, doesn't seem to change. Now, we can control for these financial constraints, competition, and regulatory frictions. So that is something we do. And what do we find? Well, basically that all of these financial frictions or other market friction doesn't seem to play a huge role when we try to understand why prices actually vary over time. On the contrary, our main results, the post times high exposure, that remains statistically significant and is still positive. So this seems to just suggest that market frictions doesn't really drive this pricing behavior. Something else is at play. We propose that it's more likely to do with risk management. Yeah, we assume that firms, high exposure firms, become more risky. They raise their prices in order to get in more income and to make sure that they have a bigger buffer to the potential financial bankruptcy that could be the result of that pandemic. And one thing that actually suggests that this is the case is a finding about exit and entry decisions. So one thing we do is we actually look at where all of these life insurance companies were active. So we focus on all states, but only on the most affected states, and also another regression specification on non-affected states. And what do we find? The only real finding we have is for affected states after the outbreak of the pandemic. So from 1920 onwards, we find there's a negative and statistically significant effect. What does it mean? It means that high exposure life insurance companies are statistically significant, more likely to exit an affected area. So this to us seems to be in line with this risk management idea. So therefore, our main conclusion is public health shocks do impact product pricing behavior. These high exposure companies charge higher premium prices. It is robust to a lot of changes in our empirical design, a lot of control variables as well. So our main conclusion is we argue this is a risk management tool that was being used by these life insurance companies because indeed that entry and exit decisions were also altered as a result of the pandemic. So thank you so much for your attention, and I'm very much looking forward to your questions and the discussion. Thank you.
Great, thank you for that. All right, so our discussant is Jonathan Rose. This one, right? No, sorry. Okay, yeah. Thanks.
Okay, well, I should give my disclaimer that I'm required to give that, these are my opinions and not those of anybody else associated with the Federal Reserve System or anybody else in the federal government. So thank you, Gertjan, for an interesting paper. Let me recap it very quickly. So in 1918, there was a pandemic that caused a shock to life insurance companies. You can see it pretty easily in this graph. You see the spike in the flow of death benefits as a percentage of insurance in force in 1918. So this costs life insurance companies money. And what the authors find is that insurance companies raise their prices in response to this shock in order to avoid financial distress. That's my 30-second recap. I have two comments about this. First, measuring prices. So what I've put on this slide is, I found this on eBay. You can find anything on the internet nowadays. This is just an example of an insurance contract from, I think, 1937. Yeah. And if you look at this, there's basically like two key terms on here. There's the amount of the contract, $6,000. That's what gets paid out in the event of the death of this policyholder. And then there's the premium down here, $196. And if you do the math, that works out to about $33 per $1,000 worth of coverage, which, as I understand, is about average for an insurance policy in this period. That's what you have to pay per year to keep the policy alive. So in the paper, the way they focus on the prices that insurance companies charge. And the way they calculate it is by taking the dollar value of new policies and dividing that by the number of new contracts. So to me, what we're calculating is the total amount of these dollar amounts, the $6,000 here, for example, and then finding the average amount of that. And that seems consistent with what I see in the summary statistics, that what they're calling the price is the average amount of the policy. Now, this is just an interpretation issue. It's not something that is a bigger problem. But I would just interpret this as a quantity rather than a price. To me, the price is the premium that you pay on an annual basis. And if an insurance company wanted to raise more money, this is how they would get the money, through the premium, because this amount is really under control of the policyholder. They can choose whatever amount they want. Also, note down at the bottom here, yearly dividend. I'll come back to that in a second. So the way I would interpret these results, which I still find very interesting, is that what they're finding is that an increase in the average size of a life insurance policy after the pandemic, rather than an increase in the price. And that is consistent with what you see in this graph, which is life insurance sales as a percent of insurance in force, lagged insurance in force. So the spike that you see in 1918, actually the spike comes in 1919 and 1920. This is people taking out life insurance in the wake of the pandemic, which, from what I understand, is a true historic thing, that there was a spike in the demand for insurance. And as the authors find, perhaps also a spike in the average size of the policy as well. So that was my first comment. My second comment is about mutuality, something that I would just love to see economists talk a bit more about, and I think that this paper might benefit from talking more about. So Mutuality is a key historical institution in the life insurance industry. Many of the largest life insurance policy companies were mutually owned. That means they didn't have a separate set of shareholders that owned the company and that received dividends. They were mutually owned by their policyholders. And so they mutually shared in the risks and they mutually shared in the profits. And if you remember that thing on the first page, I showed you the yearly dividend that the policyholders receive. Well, that is the dividend they get as the mutual owners of that company. So, and this picture you see on the right, the way that the insurance companies advertise themselves is that Mutuality was one of the ways in which they were conservative. And this is, an advertisement of a lighthouse being battered by waves, this beacon of stability in stormy seas, right? And if you look at the text down here and blow it up a little bit, they talk about how this company has survived everything from panics, wars to epidemics, and has always been a mutual company. It has never had a stockholder, and it pays dividends to policyholders only. So I think this is important for this paper. For one thing, I think it complicates the concept of pricing, because when somebody pays for an insurance policy at a mutual company, they're also receiving a dividend. And so both of these things can be adjusted by the insurance company at the same time. And so I think you really have to follow both of them to understand what's going on with the pricing. I also think it complicates leverage, because there's a measure of leverage in the paper, which is based on the amount of capital, of a separate class of capital, not owned by policyholders, but by a separate class of capital owners. And so that essentially labels mutual institutions in the data as highly levered, but they are not levered. In fact, they are completely owned 100% owned by mutual owners. So instead of focusing on leverage, I would focus on the loss absorption capacity, which I think is the key thing that the authors are trying to get at anyway. But then the bigger question is mutuality a source of stability in the life insurance industry historically? Historically, the life insurance industry, in comparison, say, to the banking sector, is very stable, has very few defaults or crises in general. There are some exceptions, but I think that's a broadly defendable statement. Nevertheless, they are profit-seeking, but I think that they were conservatively run and they were tightly regulated. And it raises the question of, would policyholders as owners, would they be inclined to raise prices on themselves in the wake of the pandemic, which would be essentially the decision they would be making. So just a little bit more discussion of mutuality, I think, would really round out the sort of the historical context of this paper. I have a couple minutes, Walker, so I'll just say some broad things then about insurance, just to end things. So mutuality, I just think it's an interesting concept. It was once far more common in financial history. There were mutual life insurance companies. There were also mutual building loans, national farm loan associations, mutual savings banks, and today we still have mutual credit unions. I don't see economic historians writing about this very much, but I think it's really interesting. I've seen more sociologists and other social scientists increasingly write about this as they write more about the history of capitalism. And so I think this is just a nice opportunity to lean into this a little bit more. I'd also say that I think it's just nice, and I appreciate Gertjan and Gustavo writing a paper about insurance companies. I love seeing research about them. They're very interesting. They have a very large footprint in some key financial markets. They're a core part of household planning. They're a rare interstate financial intermediary. If you ever read a paper that says that there were no cross-state lenders, and historically that's false. The insurance companies are the ones that did lend across states. And as I've been talking about, they have this strong element of mutuality. So I thank the authors for the paper. I enjoy seeing research on life insurance companies, and I hope these comments were helpful. Thanks.
Thank you.
We have questions. Folks, you got to come up here if you want to ask a question. Questions? Let's see if we can. No? Wood, you got to come up here so they can hear you. Otherwise.
Hello, my name's I loved your presentation. So my question is, how were just what was the basic structure of the life insurance packages? Like, did the amount of your policy increase as you invested more over time, or was it just like once you buy it, boom, you're going to be entitled to the full amount if you die?
Can already answer. So thank you for your question. There were three main types of life insurance. One of those types is actually what you're referring to. So that is the most important one is indeed you have to pay, like Jonathan said, each year a specific amount which you agree upon beforehand. That's the most important. That's called the ordinary life insurance.
Mm-hmm. Okay. But it was a fixed amount when you bought it, right? So it didn't appreciate over time or anything.
No, indeed, it was a fixed amount. Yeah.
Okay.
Yeah. Okay. Thank you.
Are there any other questions? No.
Maybe I can reply real quick to what Jonathan was saying. So if that's okay. So I thank him so much for his discussion. So the mutuality is indeed something we talked about, but haven't really dived into, because we have to collect somewhat more data on that to actually make sure, like, at what stage which life insurance company was mutual or not. So it's a very interesting idea, which we are definitely going to look into. The dividends is also something we checked, and there's not really much of an effect there. So something else must be at play, which is irrespective of that dividend policy. And for the pricing, that is something we also checked with the total premiums, and everything seems to lean in the same direction in terms of high exposure, low exposure, which also seems to be consistent with what other people were writing at the time. So we'll think about it some more, because his comments were very insightful about quantity and price. But nevertheless, everything seems to point within the story we are telling so far. But I greatly appreciate his insightful comments. Thank you.
Great. Thanks a lot. So we will move on to the next paper. Philipp, that's you.
Yeah.
Thank you.
Great. All right. Then let me share my screen. Okay. You see it? Yeah, it should.
Yeah. I think you can go to full screen.
Yeah.
There we go.
Excellent. All right. So then, hello everyone, also from midnight Germany. Hope you're enjoying the meeting so far. Today I'd like to present a project which is still pretty much work in progress. So any feedback or comments are very well appreciated. And what I'm trying to do in this paper or in this project is to look at the relationship of public pensions and health, and more specifically, whether the introduction of a public pension system that took place in the UK more than 100 years ago has affected elderly mortality rates. And if so, how? And so what's the motivation behind this? Well, as you all know, mortality has been declining tremendously over the last 2 centuries. And I think there are a couple of more or less established theories why this had been the case. For instance, an increase in living standards, which allowed people to consume more and higher quality nutrition. Then, of course, public health interventions, for instance, in the area of sanitation, and of course, medical progress. And I think, of course, we can debate on the relative importance of these factors, but I think most people would agree that they have contributed to the historical mortality decline. However, we know less about the role of the welfare state, and this is at least somewhat surprising because, at least in Europe, the emergence of the welfare state coincided with a relatively rapid reduction in mortality rates. So what I'm trying to study here in this project is a specific European welfare reform, the introduction of public pensions in the UK that took place in 1909. And what I'm trying to answer is whether this reform affected elderly mortality, and if so, via which channels. And for the first question, I mainly rely on pretty aggregated data, so therefore identification is not super clean, but still I think it's suggestive. And for the channel analysis, I use micro-level data, and I think here the causality is maybe more straightforward. All right, so what would be the contribution of such a project? Well, first of all, I think it's a very interesting reform. And it has, at least to my knowledge, not been studied in terms of the mortality implications of this reform. And so why it's interesting? Well, first of all, it was a pretty massive reform. So in only a couple of years after the pension was introduced, 60% or almost 60% of the elderly population received a pension. So essentially going from 0 to 60% in just a few years. And this happened in a time before World War I, when mortality was still pretty high and old age poverty was widespread. And also public social assistance and other pensions were extremely limited at the time. And I think all these taken together make it very likely that mortality actually responded to such a pension. And another advantage is that the reform was implemented during a time of relatively stable macroeconomic conditions, which is at least somewhat in contrast to the experience in the US and Canada, where these pensions were implemented or expanded often in the aftermath of the Great Depression. And therefore, this might be an advantage of this UK reform. And the second contribution here would be to rely on individual level census data to get some sense about the potential mechanisms that are at play. All right, just to give you a bit of a historical background. So before 1909 in the UK, old age poverty was pretty widespread and was considered a pressing problem. And this was also because the existing poor law system was considered to be insufficient. Why? Because it was attached to very harsh conditions. For instance, one had to work, for instance, in a poor house or stay in a poor house to get some benefits. And even for people who were relieved outside of poor houses, the benefit levels were extremely low. So therefore, in 1909, means-tested public pensions were introduced, and these were financed mainly on higher taxes for the very rich, so essentially the top 1%. And in order to be eligible for a pension, one had to satisfy two main criteria. First of all, one had to be old enough, right, to be at least 70, and maybe this seems pretty high given the relatively low life expectancy at birth at the time, but let me assure you, there were still many people alive at the age of 70 and older. So we have in the census more than 1 million people in England and Wales alone that were 70 or older. So this reform indeed affected many people. And the second condition for the pension were that you had to prove that you were poor enough, and this was set by a means test, and you had to provide proof to the authorities that your income was below around 50% of average earnings at the time. And once you satisfied these two criteria and some minor other ones, then you were eligible for a pension. And this pension was a fixed amount. It was around 20% of average earnings at the time, and was the same essentially for everybody who was eligible. And as I mentioned before, coverage was, I would say, pretty high, so almost 60% in 1911, only 2 years after first pensions were paid in 1909. All right, then let me jump right into the first descriptive results. So what you see here are mortality rates for England and Wales, and I'm only focusing on England and Wales for data reasons, for the period 1901 to 1913, just before World War I starts. And what you see here on the left side, so on panel A, is simply the crude death rate of everybody, or of the age group 75 and older. And what is the crude death rate? Simply the number of deaths divided by the size of the population. I would, of course, prefer to use 70 here, but for data reasons, I have to use 75. And what you see already here in this very descriptive graph is that mortality actually increased before the elderly mortality increased before the reform was implemented, and then decreased afterwards, right? And a similar pattern you can see in the second panel here in panel B. If you compare elderly mortality to middle-aged mortality, which I use as a control group, here the age group is 45 to 64, what you see is also that before the reform, elderly mortality actually increased relative to middle-aged mortality, and afterwards there's a clear trend break. So already this descriptive evidence, I think, is somewhat suggestive that there is something going on after the pension was introduced. And if you want to have some bit more formal evidence, even though it's essentially the same as in the previous slide, I've also run event time models where I first detrended mortality rates by simply assuming that the pre-mortality trends would have continued in absence of the reform, even after 1909. And if you do that, then you get these pictures, which you would have guessed already from the previous slide. So indeed, after the pension was introduced, there's a reduction in elderly mortality, and also relative to middle-aged mortality. And so essentially what I've shown you is very aggregated evidence, so that elderly mortality actually declined after the pension was introduced. And if you run this in a very simple 2x2 country difference to difference model, what you get is that, in fact, after the pension was introduced, elderly mortality declined by around 2.7%. And if you buy these event time models, then what you see as well is that the decline becomes larger over time. So around 8% in 1913 compared to 1908. And this mortality reduction is driven by fewer deaths from infectious diseases as well as non-communicable diseases, but there's no statistically significant effect on deaths related to drugs or violence, suicides, or accidents. And of course, I'm pretty aware that the evidence that I showed you before is not necessarily causal. So I've tried to do some other or look for some other pieces of evidence, and also run a county level analysis where I essentially look whether in counties that have a higher treatment intensity or for which I use the pension ratio. So whether in these counties that have a higher ratio of pensioners, whether I see larger reductions in elderly mortality relative to middle-aged mortality. And this is indeed what I also find. So in fact, in counties with a higher pension ratio or pensioner ratio, there's a larger reduction in elderly mortality. And if you use this coefficient from this triple difference in difference model, then you get an even larger mortality decline, which is implied by the pension, which is around 12%. I've also looked at other European countries, whether we see a similar reduction in mortality rates in 1909, but this is essentially not the case. All right, so this was like the first piece of evidence, very aggregated, but I still think strongly suggestive. And now let me talk about potential channels. So how did the pension potentially affect elderly health? And the first channel that I am going to suggest is that the pension allowed poor elderly people to leave poor houses, right? And poor houses were these institutions which provided shelter for poor people. And they were pretty crowded places and in fact, not very nice environments to live in. And I think it was very likely to catch a disease there. And what you see here is, and this is based on full count individual level census data, is that before the pension was introduced, so in the census of 1909, these are the red diamonds, there's a very gradual increase in the number or in the share of people living in poor houses with age, right? It's pretty gradual. And after the pension was introduced in the census of 1911, we do see a reduction in the share of people living in poor houses. And if you estimate this in a regression discontinuity design, it also comes up as pretty statistically significant. And if you use, depending on the bandwidth that you choose, here with 5 years, you get a reduction of around 0.5 percentage points or 11%. And this is also pretty much in line with administrative statistics showing that, in fact, the number of elderly people living in poor houses declined by 20% between 1906 and 1913. And of course, the question now that's important is, where did these elderly people move to, right? And what's the case is that they didn't move to similarly overcrowded places. So in fact, what you see is that also household size shows a discontinuity at age 70 after the pension was introduced, which was not there in the previous census. And also the number of rooms per person show an increase after the pension was introduced, which I think all together is suggestive that the pension reduced crowding, and which probably has an effect on infectious diseases. Right, so this was the first channel, so the crowding channel, and the second channel that I have in mind is a retirement channel. And so the idea here is that the pension allowed elderly people to retire, and this is in fact something that I have shown in a previous paper with a co-author of mine, that indeed labor force participation rates declined as a response to the pension. So at the newly created cutoff at age 70, we estimated that labor force or labor supply declined by around 13%. And I think this already is suggestive or is some piece of evidence that the pension has had a positive health effect, because work back at the time was much tougher than today. But what I'm showing you here is also that the labor supply effect differed across occupations, and it actually was the labor supply response was more pronounced in very dangerous occupations. And how do I measure whether an occupation is dangerous? Simply by the occupational specific mortality rate, which was collected by British authorities back at the time. And what you see here is that, in fact, in the occupations with the largest occupational specific mortality rate, we see the biggest reduction in labor supply at the cutoff, right? So it's not only that people retired as a response to the pension, but also they retired especially from these relatively dangerous occupations. All right, then let me already conclude. So I hope I've at least made a somewhat convincing argument that the results are at least in line with a positive health effect of the pension, and this is also in line with evidence on the US. And I argue that the reduction in mortality rates is driven by fewer deaths from infectious and non-communicable diseases, and it's due to a reduction in crowding as well as retirement, and especially retirement from these dangerous occupations. I also think that improved nutritional intake also played an important role, but I'm not aware of a data set which allows me to show this empirically. So I'm happy if you have an idea. I don't think healthcare was very important. Maybe as an interesting side note, what I also observe is that the mortality response was slightly stronger for men, right? So men see a larger reduction in mortality rates, which might be explained by the fact that they also respond much more in terms of labor supply. And also we see a larger reduction in the number of men living in poor houses after the pension was introduced. And of course, the potential policy implication of this could be, right, income transfers indeed to poor elderly people at least can save lives, which might be especially relevant for some of developing countries today, which are somewhat, of course, not completely comparable, but somewhat comparable maybe to UK in the beginning of the 20th century in terms of old age poverty and limited social security nets, and also very crowded living spaces. All right, then that's it, and looking forward to the discussion and feedback and comments.
Great. Well, thank you for that very interesting paper. Share. Are up here, right? Yep, I'm here. So let's go back here. Show it back. Okay, and then we got a little screen. Yeah, I'll let you. Yeah, it'll come down like so. Nope. Oh, you want me to do it? Full screen, yeah. Share right there. How do we do this? I don't know how to use that. 5. Sure. Nope. Yep.
Yep.
Perfect.
Okay, great. Okay. That's what it looks okay. And Mike is here. Maybe people can see me. Thanks very much for the opportunity. This is a terrific paper. And my highlight, you can see in red here, is that this is a particularly successful natural experiment as far as I can see. And I want to, in my first set of remarks, dwell on how he chose the particular context in a good way for extracting the kinds of conclusions he's after. For this initial part here, I'll be reading exactly the same text as you see here practically, because I wanted to make sure the audio and the visual were in line. This is a pioneering situation in terms of presentations. So he's exploited an economic opportunity that reveals what I would call the marginal product of a single policy package. That's not easy today because there are too much simultaneity, too many policies, too many other conditions interacting at once. This was less of a problem in his wisely chosen context. Worse yet, for today, the debated changes in each policy are often incremental and getting a bit small, and it's very hard to see the consequences in the noisy recent experience. Okay. Yet you can capture the right kind of dawn of a policy if you capture the right kind of dawn of a policy in the absence of too many other complicating factors, you can credibly isolate its effects. In this case, its life-saving effects. Isolating the effects of a single policy is important whenever, get something off my screen here. Whenever the debate centers on the effect of introducing or slashing a single policy. Like others in the new literature on the life-saving effects of new social programs, Philipp has cut the size of the econometric task, as you can see, by turning to econometric history instead of the latest, more complicated experience. And like others, he finds clear life-saving effects. In my comments here, I'd like to have us think of some of this recent literature, which he is contributing to and which he has cited, and just look at some of the results they are getting on senior mortality here. And to me, these seem, strikingly positive and noteworthy in magnitude. I would not necessarily have expected that. We know from the Fogel era debate over the determinants of nutritional status and the disease environment versus what income and food consumption could give, that this could be something where the effects didn't show. So first, in yellow highlighting there is his case. And I'll take the triple diff result of he's getting a 12.5% mortality reduction. And if I understand it, that is for the age and gender group. Remember, the policies are applying only to those who are means tested. He shows us that's a large share, but it's still only part. So those are fairly noticeable numbers. Do you get that elsewhere? Basically, yes. I'll start off with the one case where, the featured headline was that the effects on mortality of pension programs were insignificant. But this will actually prove the general point, I think. Stoyan and Fishback find insignificant effects of state laws in the U.S. late 20s, 1930s, before Social Security began to kick in at the federal level. Insignificant, but as they themselves say, basically a reason why the mortality effects are statistically insignificant, in other words, they're being eaten by the noise to a large extent, is simply that they weren't done. There was so little actual state level assistance given to people that there's just not enough there to rise up, for the signal to rise up. It would be like trying to get a demand price elasticity when the price is hardly ever changed. Okay, so they're in effect, I think, amplifying an overall larger program here. Price, by the way, in other works gets significant mortality gains from other New Deal policies, but not the pensions. USA, the bigger study by Ball and Cohen, it's actually unpublished, but it's widely known and a good finished product. She finds that if you go from the 1930s into the mid-1950s, where again, things are not as complex as they became later, you get an even larger effect for the United States. Canada, a smaller effect. But for the universal kinds of pensions, around in 1927, later extended, you get, again, a clearly non-zero, though only 4% reduction by Emery and Matheson's study. And then finally, an interesting recent case. Here I seem to be violating the guideline that you go for quite a ways back in history. But for the recent case of Russia, this is early in some sense. Here we had, in the horrible Yeltsin era, a complete breakdown. The pensions simply were not delivered in 1996 and thereabouts. And longitudinal panel household survey results from before and after that show that for the elderly, you do get a non-zero 2% reduction, the way I'm putting it, if you actually got the pension. Most did not. In other words, you're talking about in frequent Russian fashion, a gain in mortality by having the pension system break down. So that's the causal effect goes in either direction. Okay, so that. And then there is this small result that he gets that I think is very interesting, and we'd like to think about it further. He's not the only one to get this result. Why do pensions save more male lives than female lives overall? And an interesting result that his UK experience shares with the United States and with Russia is that this life-saving effect of the means-tested public pensions was a bit greater for males than for females. Why? Now, it's not because they doled out healthier pensions to the males than the females. For these means tested programs, you had to be giving these per elderly person, and they weren't that different between the elderly males and females, as I understand it, in these three contexts. Rather, the difference in life saving, these authors suggest, stems from the difference in how senior males and senior females lived without pensions. Males would have lived in more disease-prone places, like the poorhouses he mentions, and engaged in riskier behavior, not just riskier occupations in some case, but riskier behavior, tobacco, alcoholism, just not taking such care of themselves. Females, by contrast, in the absence of the pensions, would have lived more with families with whom they have this exchange of services. Basically, they're being supported by the rest of the family, but they're also giving out a lot of help to the family. So there's a nice research project that awaits you on gender and pensions and other social spending. How did the benefits for the males and females differ? That's a much larger question, of course. But if we know from other literature that's emerging that women tended to vote more for the social spending, are they really the greater beneficiaries, either in mortality or in general? Thank you very much.
Okay, thank you. So let's all right. So we've got some good amount of time for questions. If you have questions, you can come on up here and ask them. You'll have to come up here. Maybe while people are moving up here, let me start off with just a comment that I had that occurred to me. So I like the study a lot. I think it's really interesting. And one thing that occurred to me, and I don't know if this is possible, but there's been some great work recently using probate records. And it might be interesting to see if probate records could allow you to isolate mortality rates among people who would have been at the same age as these people who are receiving the pensions, but too wealthy to receive the pensions. That might be an interesting avenue to gain a little bit more identification leverage. Okay, we've got a lineup, so we'll take a couple and then you can respond.
All right, great. I enjoyed this quite a bit. So I guess my question is mainly on the cost side. So if I recall from the talk, you sort of talked about this tax on the top 1%. And I guess I would really like to know a little bit more about the cost side. And can you give us something along the lines of like, what's the cost benefit in terms of like the years of life and the value of those extra years relative to the cost of the transfer? I think that would just really be a nice top line number. But the years, sort of life years, may not be possible given your data.
Yes.
Carl Kitchens.
Questions that to do with mortality. Oh, hi. I'm Neil Cummins, LSE Economic History. Thanks for the talk. So this might be kind of very straightforward to address. Maybe I'm missing something, but I was thinking about your measure of senior mortality, and I'm wondering if that's standard in this literature, this idea that you're measuring mortality by the deaths of people age X and above to the population aged X and above. Isn't it the case, though, that like if this welfare program is coming in conditional on your age X, that there's significant incentive effects to declare yourself age X if your age is actually X minus 2, right? So it's got to be, and the mortality rate can go down just driven to that pure effect. So, I mean, one suggestion is that I'd like to maybe, I don't know, I mean, I'd just like to see a little bit more work on the distribution, I guess, of age at death. That would, that would detect it, right? If you could do that somehow. I don't know with that aggregated data whether you could do it, and then your micro data, people haven't died yet. So I feel like I'm talking to myself here. I'm sorry, but yeah, I think you're going to need to address that point. Thank you very much.
Two more? We'll take two more questions and then we'll give you a minute.
All right, I have to take notes.
Yeah. We'll get more feedback, I think.
Hi, I'm Matt Pesner, a PhD candidate at Vanderbilt. So interesting paper. I have a couple questions. Number one, you said that this is a means tested program paying out 22% of average earnings. I was wondering about whose average earnings that was and how that compared to average rents at the time. And if this is kind of, unlike old age assistance in the United States, if this is a flat benefit, if variation in rents by locality is something that you can use for identification. Number two, it seemed like your labor force participation results were kind of high, particularly that you were motivating this as being not in the post-depression environment like old age assistance came in this country. And so I was just wondering, how those, and I know that it's from your earlier paper, but how those results compare to evidence from OAA and labor force participation in the 1930s in this country. Thanks.
Okay. Last one.
Hi, first of all, thanks for the great presentation. And I'm Ezra from Princeton University, PhD student. And I had just a quick question about the crowding effect on the poor houses. So would you see any effect on the people that didn't get the pension? So my guess is like, if there is enough people that leave the poor houses, then there would be a spillover effect on everyone living in the poor houses because they're less crowded. So maybe there's not enough people that are going outside of the poor houses, or do you find any effect on the rest of, on people that maybe are close to the age to get the pension, but still have to live in the poor houses? So do you have anything about this? Maybe you said something and I lost it, but that was my question, my curiosity. Thanks.
Okay, so very good questions. So we have about 3 minutes.
All right.
Just respond to what you want to.
Yeah, great. That's always great. Maybe to the cost benefit first. Good. That's a very good point. So far, and this probably relates to the other questions as well. So far, I'm really using very aggregate mortality data, not on a single age group level, right? So not even so. I only have 10-year age group deaths. So therefore, it would be maybe it's a very good idea to look at these probate records to get the really exact age. This is a very nice suggestion. With respect to age manipulation, right, in order to receive the pension. So what's at least somewhat reassuring that in England and Wales, we had these birth registers since I think 1837. So at least people that were alive, that were 70 were covered. So there were birth certificates already existing for these people. So at least in England and Wales, right? So in Ireland and in Scotland, it was very different. But we showed, like in this previous paper, that in fact, age manipulation, at least in the census, there's no evidence that the pension resulted in age manipulation. So maybe this is at least somewhat reassuring. With respect to regional differences, yeah, that's a great point. So I thought about really looking at different effects on urban and rural areas. So this is indeed something I want to investigate in the future. The comparison of the labor force participation result to the US, I mean, probably you are aware of the Feder-Lockwood paper on OAA in the US. And essentially, the labor force participation effect is very similar in the UK. So it's not so different. If, like, in fact, the difference is simply driven that we included women as well. But if you only look at men, essentially it's more or less the same. Yes, crowding and the poor house, the last question. I'm not sure I completely understood. So what I don't know is, like, in the census, who actually received the pension. So this is information that I don't have. So I only identify this using age, right? So this is essentially an intention to treat idea. So it would be great to know this, but from the census, I can't get this information.
Okay, great. Thanks a lot.
Thanks for your comments. Excellent. Great.
Next speaker is Ezra Goldstein from Florida State. Let's see here. This one. Yeah. I got it. All right.
Yeah, I'm gonna do that right now. Okay, cool. Can everyone hear me? Okay, cool. Hey everyone, thanks for sticking around. I'm Ezra Goldstein. I'm a job market candidate from Florida State University. I wanted to be a little festive. Halloween's my favorite holiday, so that's all I get to do. But so my research mainly focuses on thinking about how family structure affects the long-term outcomes of children, as well as topics in sort of child welfare and child welfare policy. So this is a paper about sort of the former sort of research topic, and I'm thinking about sort of long-run effects of disruptions to parental structure, specifically thinking about parental death. In economics and in sort of social science more broadly, there's a large literature dedicated to thinking about the formative role that parents play in the development of their children. The quantity, the quality of investments that parents make into their children matters for children's sort of short run and long-term successes. And we know from works like Heckman and others that the timing of these investments matters quite a bit. Investments during early years seem to reap the largest rewards, and specifically disruptions during early childhood seem to matter quite a bit for the either short and long run success of kids. This has sort of spawned this research that's focused on sort of these disruptions to the family structure and how those may how those may affect a child sort of in the short and long run. Among those disruptions is, of course, the death of a parent, which we know relatively little about, and we know even less about the longer-term effects of what happens to a child if they lose a parent. Why do we know so little about this? Well, it's difficult to study, right? You need long-term data that allows you to track a child from early childhood all the way to adulthood. You need some way to sort of argue you have some plausible counterfactual. And not only that, in sort of the modern context, it's hard to isolate the effect of parental loss alone. We live in a time period with institutions that provide some forms of generous sort of compensation for families who lose a loved one. So it's really difficult to sort of isolate this effect. So I'm going to try and do just that by bringing history to this question. So what I'm going to do is construct a longitudinal data of sons who lose their parents. And I'm going to sort of just, of course, and given this is an economic history conference, I don't really need to spend too much time talking about census data, but I'm going to create a sort of linked longitudinal set of census data of children linked to their adulthood outcomes in 1940, where I can observe their wage outcomes, their education, and so on. And I'm going to combine that data with a novel identification strategy that kind of relies on variation in mortality from mining accidents. The plausible kind of simple counterfactual idea that you want to think about is a rock falls and kills one father, and a rock falls and maims another. One parent survives, one parent dies. What happens to their children? I'm going to sort of rely on these accident records that I'll talk about in a little bit here from 1900 to 1930, so the early part of the 20th century. So just to give you a very quick preview of the findings, if you have to jet out the door right now, just know that it of course seems that losing a parent is quite detrimental for the long run success of children. So on average, sons that lost their fathers experience about a 4.5% reduction in wage income as adults. And the age at which a child loses their parent seems to matter. Sons who are less than primary school age experience a much larger reduction in their wage income as adults, between about 13 and 16%. I do a little bit to try and sort of peel away the layers and think about channels and mechanisms. And what I kind of show is that it seems like these sons are much less likely to be sort of working. They're kind of less attached to the labor market. I rule out that these differences are coming from education or occupational differences. And I provide some very suggestive evidence that there may have been some differences in early childhood investment after the accident occurred. So I'm going to talk very quickly about sort of mining in this time, the data, the identification, going to the results. So miners in the early 20th century performed some of the most dangerous work in American history. Between 1900 and 1930, nearly 70,000 workers perished. It's about 4 per 1,000. It's not the big explosion or the collapse of the mine that killed a lot. It was the small scale accidents, like a fall of a rock or a faulty mine car or someone falling off a ladder that was the cause of most accidents. Of course, non-fatal accidents were far more common, and the injuries ranged from debilitating, like loss of limb, to some inconvenience, like a cut or a gash. In the early 20th century, it's important to think about sort of the compensation that families of accident victims would have been entitled to. There were some public and private insurance systems that existed for the families of the bereaved. Mostly, there were benefit funds between workers and mine operators that provided some death benefits. But before workmen's compensation, disabled workers were rarely covered. Death benefits were far less generous than you might think. Mostly, families received about half of annual wages for about at most a year. Those miners who were entitled to sort of disability benefits would receive, maybe a third of wages until they could get back to work. So again, this is a time period where the compensation is far less reliable and far less generous. So I'm not going to spend too much time talking about the census data. And I want to, given that this is EHA, I want to get to the picture of the mine records. So the records that I'm focusing on come from Pennsylvania, Illinois, West Virginia, and Ohio between 1900 and 1929. These are annual inspection reports that list individuals who are killed in an accident and individuals who are involved in a non-fatal accident. Altogether, there are about 180,000 accidents that I collect, and these account for roughly 3/4 of all fatal accidents in this time period. So here's just kind of a brief example of what these records look like. You can see, useful for linking, we have name, we have age, the date of the accident, so I can back out birth year, and a brief description of the accident. You can see that most of these are, individuals who are instantly killed when a rock falls or when the mine car crushes them. These are very sudden and quick incidents that led to fatal injuries. So I'm going to take these records and in 2 steps link them to the census. First, in the first step, I'm going to link individuals to the 1910 and 20 census, and I'm going to find about 50,000 or so of them in the census. The matching rate is about in line with what you would expect. And of these linked individuals, about 20,000 of them are fathers. So I'm going to, from these fathers, try and collect their sons. So in the second step, I get about 16,000 sons of accident victims, and I'm going to match them forward to 1940, where I can see their sort of labor market outcomes, their wages and so on. For my main analysis sample, I'm going to focus on those who are sort of complete in their records, that they have sort of no missing sort of responses, but I do some robustness in the paper. And I'm also going to have a sample that links some of these sons to the nearest census after the accident occurred to try and see if they're still in school, and also to examine the mothers. So again, the identification strategy is really, really straightforward, or at least I think it is, where we're going to try and hope that the adulthood outcomes of children of non-fatal accident victims are a reasonable counterfactual for those bereaved sons, the sons who lost their fathers. So again, the simple imaginary experiment is you have 2 miners in the same county, both involved in an accident. One dies, one survives. The necessary condition is that fatality shouldn't be related to any characteristics. And if I show sort of the differences between the fathers who eventually die and those who are just in the same state, we can see, of course, they're quite different. But if I compare these fathers to those who don't perish, we can see that they're quite similar. So this is kind of a nice balance test. The simple estimating equation, I'm going to have on the left-hand side the adulthood outcome of the son in 1940. For simplicity, you can think of that just as the wage. I'm going to, have the standard array of fixed effects and characteristics of the parent, and then beta is going to represent the average difference between children of fatal and non-fatal accident victims. I'm going to cluster my standard errors at the adulthood county of residence. If you don't like that, you can bother me about it. The first thing that I want to show you, I'm going to go through this quite quickly, is that orphan sons experience between a 3 and 4.5% decline in adulthood income. When I see them later, it's about a $1,400 difference in 1940. It's about 2 years of lost income. Yet these estimates are actually quite similar in magnitude to some of the papers that are able to look at the long run effects of those who lost their fathers. So other papers find, either between 2 or 6%. And then what I want to think about is, well, this effect might be masking some heterogeneity. Those sons who lost their fathers when they were very young may have been quite different. So I'm going to modify this equation slightly and think about those who are younger than primary school age, so younger than age 6 when their father died. So now beta is going to represent the effect of parental death for those who are older. And I find that it's really not coming from this group. These individual kids who were sort of older when they lost their fathers don't experience this substantial decline. It's really coming from these sons who were much younger when they lost their father. I can also sort of trace out this effect in different ways. Here's if I kind of specify kind of a parametric linear assumption of the age of the effect of the death at the time of accident. And we can see that those who are very, very young experience the most pronounced decline, and that this effect sort of attenuates as children, when by age at the time of the accident, kind of becoming insignificant around 10 or 12 years old. I do some robustness checks that I don't want to talk about, but basically, regardless of functional form, we can see this effect. Really, the effect is coming from relatively few sons. I can do all sorts of sort of randomization inference to think about how to do that. And I also do some inverse propensity weights to account for selection and pooling sample. Of course, thinking about potential channels is really difficult in this setting, right? Why are these sons so different when they lost their fathers? So what I'm going to first show you is that these sons who lost their fathers at a relatively young age, so the ones who are younger than primary school age when they lost their fathers, the ones who have the largest effect, are way more likely, about 67% more likely to be unemployed as adults. They're also way more likely, almost 25% more likely to be working a relief job. And they work about, I think that's 6%, about 2 weeks less on average. So there's this kind of general finding that these sons are just having worse labor market outcomes more broadly. The question is why? Well, perhaps they are working in worse occupations. It doesn't really seem like that's the case. Whether if I look at the income score, if they're working sort of higher skilled jobs, it doesn't really seem like these sons are sort of working in terrible or worse earning occupations. If anything, they're slightly more likely to work in lower skilled occupations, but this effect is not statistically significant. So suggestive if anything. Perhaps these sons are just having worse educational outcomes. That doesn't really seem to be the case. So what could it be? Maybe it's that these sons were experiencing sort of reduced parental investment in the household. So what I try and do is think about what the wives were doing or the mothers were doing after the accident. So these are the outcomes of mothers who lost their husbands. And what I find is these mothers were way more likely to both still be widowed and or to be widowed in the first place and be listed as the head of household and have joined the labor market relative to wives whose husbands did not perish. I try to think about the relative importance of channels. For the sake of time, I won't really go into it. And I just want to conclude by saying where I think what my paper is able to really say and why I think it's important. There's, again, this nice literature that thinks about these disruptions, how these disruptions that children experience ripple through their lives.
parental death, in my mind, is one of the most severe traumas that children can experience, and it's hard to really study. And it's hard to study the long-term effects of this trauma. So what I view this paper as doing is kind of documenting the persistence of these effects and showing how it can perhaps not only disrupt a child, in school, but also in their labor market outcomes later on in life. And I'll stop there. Thanks.
All right, so our discussant is Erin Troland.
Yes, give me just a second. Share my screen. Okay.
There we go.
Okay, great. So excited to, I guess, virtually be here. This is interesting. This is my first hybrid conference to discuss Ezra's paper. I thought it was super interesting and super interesting context, great data collection. I just had a few comments and like the discussant, a few discussants before, these are my views and not those of the Federal Reserve, the usual disclaimer. Okay, so this paper answers, or it contributes to answering a big question, right? How does losing a parent affect children's success later in life, right? And so we know that there's this big literature on early stage investments or lack thereof that can have lasting impacts on children. I actually think this is pretty topical given what's going on with the pandemic. There could be, people are thinking, what are the long-term effects of the pandemic going to be? And one of them, there's obviously potentially employment scarring, but there could also be scarring from children having parents having passed away in the pandemic. So I think that's another potential tie-in for the paper. And so this paper specifically follows these sons of coal miners that were involved in these mining accidents, right? And the clever thing here, and it's a little it's a little morbid, I have to say, reading this paper, but it is clever, right? That basically you have these two groups, right? You have sons who lost their fathers in a mining accident, and then you have sons who didn't lose their fathers, but their fathers were seriously injured. And so the idea here is that sort of dying, the sort of worst possible outcome is as good as random, though I think sort of my main comment here is going to be that the kind of less bad outcome is still bad. And so what he finds is that sons who lose their fathers lose a pretty substantial amount of wages later in life, and they're more likely to be unemployed. So in looking at these channels for why we would see these wage effects, he also looks at whether sort of education is playing a role. And I thought, though now that, it seemed a bit surprising to me that there really wasn't a whole lot there on the sons being no more likely to drop out of high school in those who lost their father versus those who didn't. Okay. So my main comment is really on this control group. And so I think the control group, and this is, I'm sure, something that Ezra knows, but I think could be maybe more, could be called out specifically in the paper, is that the control group fathers are still very much affected by this accident, right? And so in the paper, basically, these control group fathers are defined, are listed in this mining registry as being injured if they lose more than 30 days of work, right? And so that could actually still very much affect sons or daughters or the whole entire family if fathers are disabled or less likely to work, right? And so they could potentially earn less, and that could also reduce resources for the family, right? And that could also have a pretty big impact on the family. And so, I mean, I think in some ways this is, right, an underestimate of the effect, because this control group is still in a bad situation, right? And I was thinking as I was reading this, well, maybe this is why we don't see results on sons dropping out of high school, though now that I think I read this paper about a week ago, and maybe there was a new graph or I didn't notice it, but the results on the younger kids makes me think maybe this isn't true. But I was thinking if the control group sons are still having to supplement wages if their father is injured, then and less able to work, then maybe that's why you don't really see effects on employment, or on education. But that may be less true if the effects are basically all coming from really young kids. But anyways, my suggestion is to construct another control group from the census. And I know this won't be as causal as the design now, but I think it could add something to the paper, and that you're gonna be able to compare. You could construct another control group of mining father-son pairs living in the same states, and then you could compare that group where nothing happens to the fatal accident group and the non-fatal accident group. And again, this isn't going to be nice and clean and causal, but I think it'll give us an idea of sort of how much of a kind of underestimate this effect is when your control group is a group that is still very much affected it still very much experiences a negative shock. And so you might be able to kind of say something about the effects of death versus the effects of disability when you compare it to a group where they're mining families. You might even be able to do something with they're mining families that live in the same areas, but they don't actually experience this negative shock. So that's sort of my big comment. My second comment is just thinking a little bit more about the healthcare that was available, and this is more just on the context. Thinking about sort of how were these miners treated for injuries? Were they ones that maybe had serious accidents? Did they receive healthcare and able to be rehabilitated? Was their healthcare where was it coming from? If it was coming from company doctors, then there's some reason to think that those doctors might have had an incentive to downplay injuries to avoid the company having to pay out workers' compensation claims. And so I think it would be helpful to understand a little bit more what would happen to those fathers who were seriously injured and how they might have been cared for. And so my suggestion here is I can send you these slides. This Department of the Interior report on healthcare in the mines. It's a little bit later than the context of this paper, but I think it'd still be helpful. It's a pretty long report that goes through kind of the medical, the healthcare and medical conditions in the coal fields in the 40s. Okay, I'll stop there. I have just some miscellaneous comments on the next slide that I'll send directly to Ezra, and I'll stop there and let other people ask questions.
Great, thanks a lot, Erin. So get in line if you want to ask questions. Maybe I'll start with so one thing that struck me, as an economic historian, the interesting thing, or one of the interesting things that I think you could do is, right, there's modern literature where I think, they can estimate these effects on children. But what's really interesting to me from an economic history perspective is the aggregation of these effects in an environment where you have lots of accidents and lots of really dangerous occupations, and how big that aggregate number might be, and how that aggregate number might change over time using your estimates, and then thinking about mines getting safer or other occupations getting safer. That might be an interesting direction to push. Okay, Taylor?
I'm Taylor Jaworski, University of Colorado. So I have two comments. One, brief. So one comment is, I think it would be useful to have a balancing table for the matching part of your paper to convince us that as you go from everyone to 183,000 to 5,000, that 5,000, that those people are representative of people in the population, fathers, but then, so I think that's important, and it's different from the balancing test that you showed. And then the other thing is, I think it would be useful to kind of draw on the literature that you sort of made reference to in your slides on workers' compensation. And I don't know if it's an important econometric part of your paper, but maybe it is to exploit the variation in the states of adoption and the generosity of workers' compensation benefits. But even in the absence of a kind of formal exercise, I think to kind of tell us something about how the workers and the people, the sons in your environment might have been treated differently by these worker compensation policies. Would be interesting, and maybe it could be an econometric part, but I don't think it needs to be useful for your paper. Thanks.
Yeah, it's a very interesting paper, and I'm wondering if it's successful as a strategy. We're going to have papers then on people who die in car crashes versus people who survive car crashes. And I know already that people have looked in Germany at people who survive World War II versus people who die, again with this idea that there's going to be randomness. But you went over very quickly though the evidence that death really is random in these cases. And I just still got to believe that people who are in mines in better areas are perhaps more likely to survive these accidents. And also that people with better social abilities in some ways are again more likely to be able to take precautions that enable them to survive in these cases. And so I think it may be there already, but it would be nice to see even very convincing evidence that there really isn't any differential in survival probabilities.
So Ezra, thank you so much for this interesting talk. One thing I thought would be interesting to discuss a little bit more in the paper is like the institutional background of how mining companies pay their workers. Because, for example, in West Virginia, they don't necessarily pay them with actual money, but with vouchers that they can only redeem in the shops in these very remote rural areas. And so if you can say a little bit more about this institutional setting, the geographic mobility of the kids and occupational mobility of these kids. I think that would be helpful to see if these kids are still more likely to be minors.
So this is a great paper, but I'm still confused about what the actual mechanism is. What is it about a father's death that leads to worse occupational outcomes for the son? One possibility is that it's simply having a father around to get you in the door. Mining communities tend to be isolated in one industry places, and it might be that having your father there to help you get the job might work. Now, there are a couple of things you might be able to do to look at that. Look at which communities have more diversified industries might be one thing. Another thing that would be interesting is to see if having kin nearby is a help. And kin, uncles. And Matt Sobek at IPMS has an index of kin in the nearby. And it might be interesting if you and Matt could team up and see if sons who were more likely to have kin actually had better outcomes than those who did.
Hi, Neil Cummins, LSE Economic History again. For first issues, just really echo Greg's point here. I think this paper, you have to convince this critical reader that this is truly random, but there's going to be all sorts of behavioral traits like wearing a helmet and not engaging in risky behavior that results in your risk of dying once having an accident. But I think one thing you could do on that directly is, instead of these two groups that you're comparing, that you could look at the sons or the offspring of men who die. Look at brothers, because each brother will get a different dose. So brothers, unless they're twins, are different ages. So the younger one is going to have a more severe effect. And of course, there's going to be time trend issues, but you should be able to get at that from your other data so you can estimate it if there's a time trend between brothers. But I think that for me would be a much more convincing way to go. But yeah, thanks. Very interesting.
Okay, great set of questions. Do you want to take 1 minute and respond, or? Yeah, you have a minute. You want to? We're close enough. Go.
Okay, I'll go in reverse order.
You don't have to respond to everything.
I won't respond to everything, but only the ones that I've definitely absolutely tried and wish I could say more on. So, Neil, to your point, I have tried that, and unfortunately, sort of the like within family brother fixed effect cuts the sample down to the point where it's like not usable, because it cuts it down to basically 500 kids. So that it's quite. I can try and think of other ways to do that, but that's a point very, very well taken. I'll just kind of jump to Greg's point as well, which is to say that, you know, like in terms of sort of the commentary of what these miners knew about sort of the safety of the mine, right? There's some evidence that they sort of, you know, if an accident occurred, a severe accident occurred, they knew, you know, whether or not they were internalizing that as this mine is unsafe, so we're all leaving. I think that there wasn't a good sense of sort of that happening. Now, in terms of sort of that there being differences by the miners, it's a tough thing to answer with data, but certainly I can definitely and will do more to sort of think about some contemporaneous narratives of who were these miners that got involved in these accidents, and talk about that a little more. That's a really good point. Boy, there's so much. I'm just going to kind of end it there. And other than to say, Erin, thank you so much for your comments. They were very useful. And I'm looking forward to kind of chatting about them and catching up. Thanks everyone so much.
All right, so thank you to all of our speakers and all of our discussants for a great session, and I will close the session now.